For more than a decade, Uganda's financial sector has rode on success and non-turbulence until the ripples of the global economic crisis fully reached here. At the most basic level, it produced the impasse between traders and banks.
It's been, you're right, a wake-up call in many ways. In some cases, people would say it's been a rude awakening.
Awakening to what? That people borrowed without full awareness of what they're dealing with, as long as things stayed calm. Henceforth, banks will inform and educate borrowers on what they are getting into before cash is disbursed.
We will actually ensure that we sit down with customers as banks and go through all of that. We will also ensure that the documentation which we have is actually going to be simplified.
But on the issue of most contention, the banks will not revert to old interest rates on old loans. In explanation of why, let's assume customer A deposits 100 million with the bank and customer B also comes to borrow 100 million from the same bank.
We actually take the money that we receive from customer A and we lend it to customer B. What happens is, at some point in time, customer A comes back and says, thank you for keeping that money for me, and thank you for keeping it safely. I now want it back.
Because that money is already lent out, the bank must go into the market to look for the cash to pay customer A.
When we do so, it means that we can now no longer apply the same interest rate to customer B who took this money some time back. Because the money which was funding him, the cost of that new money has now changed.
And therefore, you who has borrowed takes on different rates if your loan was with a variable interest rate. If you find it difficult to grasp all this, demand that your banker explains it to you. Samuel Setumba, NTV Business.